I think we can start.
Okay, thanks, Victor. Thanks for the introduction. Welcome, everyone, and thank you for joining today's session on most common misconceptions about RWA tokens. So real-world asset tokenization is one of the most talked about developments in digital finance right now. Yet, despite the growing interest from founders, asset managers, institutions, much of the conversations are still shaped by assumptions carried over from early crypto markets. So today, we have a very interesting agenda. By the way, Victor, is everything okay with the sound and the presentation?
Yes, it is.
Okay, so now we see the agenda on the screen. We'll cover, we'll go through some of the most common misconceptions about the ownership, securities classification, liquidity, offshore structures, and more. And we will clarify what RWA tokenization actually is from a legal and structural perspective. The goal is not to just correct the misunderstandings, but to help you or the founders of tokenization projects think more strategically about how to design a compliant, scalable, tokenized product from day one. Okay, so let's begin with the first misunderstanding. Tokenization is fundraising. So is it fundraising or is it not? Let's see. Tokenization and fundraising are related, but they are not the same thing. Confusing the two leads to regulatory mistakes, delayed launches, structurally flawed projects. So let's unpack the difference. So what tokenization is? Tokenization is a technical and legal structuring process. I would say even more technical. It involves designing the legal wrapper, which could be equity, debt, fund units, profit participation rights, etc. Then we have mapping investor rights into smart contracts, structuring issuance mechanics, aligning the instrument with applicable securities law, and only then creating a digital representation of rights linked to that underlying asset. So that technical aspect of tokenization usually comes after all the legal structuring steps. Tokenization answers the question, how will rights be represented, transferred, and managed digitally? It is infrastructure design. You can tokenize real estate, debt receivables, fund units, equity in the SPV, revenue streams, infrastructure projects, but tokenization alone does not determine who can buy the token or how it can be sold, how investors can be solicited, how can you promote the token. Fundraising basically fundraising in that whole process is a regulated capital raising activity, and that involves offering securities to investors, marketing or promoting those investments, those financial instruments, targeting specific jurisdictions, structuring private placements or public offerings, complying with investor qualification rules, filing exemptions or prospectuses. Fundraising answers the question, under what legal regime can we sell this instrument, to whom, so basically what's the investor profile, and how. This is where securities regulation becomes central. In Web3 culture, token launch often historically meant capital raise, but in RWA tokenization, the landscape is different. Tokens represent regulated financial instruments, hence distribution triggers securities law and marketing triggers financial promotion rules. And what most important and complex, cross-border offers require jurisdiction by jurisdiction analysis. You can tokenize an asset perfectly and still have no lawful pathway to distribute it if you started with the technical step and just ignored all the legal peculiarities, legal structuring requirements, and authorization requirements to actually offer those financial instruments to investors. Likewise, you can structure a compliant private placement without using blockchain at all. They are separate layers. So let's take an example of a real estate tokenization, very popular topic right now. So imagine a property SPV. So step one would be to tokenize equity in that SPV. Rarely real estate is tokenized directly, where token holders actually own a piece of real estate. That is at the moment only possible under some pilot regimes in Dubai. Usually the tokenization of real estate is structured through special purpose vehicle that holds the real estate, and then that SPV is tokenized. It could be the shares in the SPV, it could be some economic rights linked to the real estate. So step two would be, let's say you want to sell those tokens to 10 or 10,000 investors across EU, let's say. That is fundraising when you actually start taking money in exchange for those tokens. Now the regulatory question begins. Is this an alternative investment fund under EU law? Is this fund does this fund require an alternative investment fund manager? Basically, that's a separate entity, separate licensing regime for fund managers. Are you making a public offer, or are you just selling those tokens on a private placement basis? Are those investors retail or professional? Do you need a prospectus, or will you just stick to private placement or use some other exemptions from filing that prospectus? Does the marketing trigger financial promotion regulations? Tokenization does not solve all those issues, does not answer all those questions, regulatory questions. Fundraising strategy does. So why this distinction matters strategically? Projects that treat tokenization as fundraising often underestimate that regulatory exposure, structure the wrong instrument, trigger unintended fund classification. Sometimes market prematurely without having the right authorizations and without adhering to compliance requirements in their marketing communications. Face banking and custody frictions. That's very important because tokenization usually involves the network of service providers like custody providers, placement agents, transfer agents. So this is very important to make sure you are going to be able to be onboarded with all those providers, with the bank, with the custody provider. So the correct approach is layered. It would be first to define the asset and investor model, then choose the legal instrument, determine the regulatory distribution pathway, and then design the tokenization infrastructure. So technology follows legal strategy, not the other way around. Tokenization is a product architecture. Fundraising is the regulatory strategy. Tokenization defines rights, structure, governance logic, distribution mechanics on chain on-chain implementation actually is the tokenization, but the fundraising defines who can invest, where they can invest from, under which exemptions, which disclosures are required in terms of the investment risks. So both of those processes must align. They are not interchangeable. They are not the same thing. The most successful RWA projects understand this early. So basically, tokenization is a tool. Fundraising, again, is a regulated activity. And we don't want to confuse the two, which would create unnecessary risks. So clear legal architecture turns tokenization into institutional grade infrastructure instead of an unlicensed capital raise. Okay, so this was on the first misconception. And let's move to the next topic. Are tokens the actual fractions of ownership, fractions of the asset? Does owning a token mean owning an asset? Let's discuss this now. Okay, so tokens do not automatically equal ownership. This sounds simple, but in practice, it creates major confusion, I would say, especially for unexperienced investors. When people hear tokenized real estate or tokenized equity, they often assume that holding a token means they are directly owning that asset. Legally, that is rarely the case. And not because the token issuers are trying to take advantage of investors, it's because actually issuing a token that would represent a fraction of that asset is too complex in terms of the regulatory and legal risks at the moment. Maybe over time, the industry will evolve and we will have sufficient regulatory frameworks to offer something like that, where a financial instrument, a crypto token, would actually mean that you own a specific asset or a fraction of an asset. But at the moment, this is too complex for projects to implement. So what does a token actually represent? Usually it is a digital representation of rights. Those rights can vary significantly depending on how the structure is designed. It can be equity in an SPV, a debt claim, units in an investment fund, contractual profit participation right, or simply access or governance rights. So the tokens could be designed with various set of rights. The token itself is not the asset. It is a wrapper around legal ownership. If that legal relationship is not clearly defined and enforceable, the token is just a code, basically. Again, we can go back to the example of the tokenized real estate. You have a property held in the SPV. If you tokenize shares in the SPV, the token may represent equity. A note issued by the SPV, then the token represents debt. If it's a token that is linked to profit participation agreement, the token represents contractual cash flow rights, contractual claim towards the issuer. In none of these cases does the token holder directly own the building or a fraction of that building. They own rights against that legal entity that issues the token. That distinction matters enormously because there are bankruptcy scenarios, investor protection, voting rights, exit mechanics, regulatory classification. So depending on that legal wrapper, the token will be treated differently by the regulators. So when tokens are marketed as ownership, regulators become cautious because ownership implies legal title, voting control, if it's about the SPV, then asset claims, fiduciary protections. If the structure does not actually grant those rights, misrepresentation risk arises. You just trigger some misleading in your investment communications, investor promotions. The biggest issues appear when marketing language suggests ownership, but documentation creates only contractual exposure. So basically, then you are not completely transparent with potential investors. Or when investors assume direct asset claims, this creates regulatory exposure and litigation risks. The blockchain ledger does not replace corporate law. Legal enforceability still sits off-chain. A token is a delivery mechanism. Ownership is a legal status. They are not the same thing. In RWA tokenization, the real question is not, is the asset tokenized? The real question is, what legal rights does this token represent and how they are enforced? That is where structuring becomes critical. And when it comes to the documentation you offer to your investors, the clear documentation must define what rights are attached, what rights are not attached, how those rights are enforced, and what happens in downside scenarios, which could mean insolvency of the issuer SPV, for example. Your investors must have transparent information, transparent documents outlining all those aspects of your RWA token. And now we are moving to the next topic. Is that RWA token a security or a financial instrument? So not every token is automatically a security, but most RWA tokens are. I would say all RWA tokens are. This distinction is critical. In Web3 discussions, we often hear two extreme statements. All tokens are securities, and if it's on-chain, so it's not a security. Both are oversimplifications. What makes something a security? Probably many of you, if not all, heard about Howey test. Similar tests are applied in different jurisdictions. The Howey test was born in the US. So regulators don't care about the word tokens. They look at economic substance, economic reality. A financial instrument is typically treated as a security when it involves four elements: investment of capital into a common enterprise, common project, expectation of profit from investors' side, reliance on efforts of others to generate that profit, and in some cases, exposure to an underlying asset or business. If your token gives investors profit participation, yield or interest, dividend rights, revenue share rights, asset appreciation exposure, it will very likely be treated as a security, regardless of the technology and regardless of how you call it, regardless of maybe even how you promote, because the regulators will assess what really is promised to investors. What does the investor get with that token and attached legal contracts? In RWA tokenization, tokens structured as equity in the SPV, debt notes, fund units, profit participation certificates are almost always securities because they represent regulated financial rights. Putting them on blockchain does not change that classification. When tokens may not be securities, there are situations where tokens are not securities. If it's a pure utility tokens with no profit expectation. So basically they have consumptive use. Where the token holder can redeem them for access to some ecosystem functionality, or maybe for fee discounts and stuff like that. In some cases, it could be a governance token without any economic rights. Access token to a service. Payment tokens functioning as digital money are also treated differently under different set of legal frameworks, not as securities. So this is rarely the case in RWA projects. RWA tokens are typically investment products. And the next misconception we often hear is that tokenization does not, that the tokenization offers improved liquidity versus traditional financial instruments. But in practice, tokenization does not automatically create liquidity. Putting an asset on chain does not mean it can suddenly be traded freely or at scale. Liquidity is not a technical feature, it is the market outcome. Tokenization can enable fractional ownership, standardize asset representation, automate settlement, transfers, maybe reduce operational friction, which are really important enablers, but none of them guarantee buyers, sellers, or active markets. Liquidity depends solely on investor demand, a clear pricing and valuation, transferability under securities law, and as described and permitted in the underlying agreements linked to those RWA tokens, and eligible investor base. Compliant secondary trading venues also are important factors when it comes to liquidity. And of course, market makers or natural turnover of those tokens. If any of these are missing, a tokenized asset can be just as illiquid as off-chain equivalent of that token, which is the financial instrument. So why RWA tokens are often illiquid? In the tokenization, liquidity is often constrained by design because of those complexities of current legal frameworks. Securities law transfer restrictions are there in most of the countries. Certain lockup periods could be embedded into the token and attached legal documentation. Most of the projects start with professional-only investor as a target audience, again, because of the legal complexities, because of the regulatory frameworks that that make it too complex and expensive for startup issuers to actually go retail. And because this retail exclusion and professional only target investor profile would mean limited number of eligible buyers. And another problem is the absence of regulated secondary markets. Well, it's not the complete absence, but those regulated secondary markets for securities, for digital securities, for security tokens, RWA tokens, are still limited. They evolve fast. They every day or maybe every week we hear news of large crypto players, large exchanges obtaining additional licenses to allow to allow listing of those security tokens, to allow secondary trades. So there are certain platforms that enable the issuance and secondary trades of security tokens, but the infrastructure is not yet as developed as for non-security tokens, for general crypto coins or utility tokens. It's not yet as developed. And there are many projects also cite that because RWA tokens require every potential investor to pass KYC and become whitelisted. Every wallet needs to be whitelisted before they can purchase that security token. That also limits the amount of participants in the market and creates additional complexities for the projects. So all of them must implement those KYC workflows, KYC procedures for investors, a filter of all the sanctioned individuals, politically exposed persons. That is another hurdle that many projects face, but they will have to adhere to it because anti-money laundering and KYC procedures are mandatory for all kinds of regulated projects, including RWA tokens. So those constraints are not really technical ones. They are legal and regulatory. And over time, we might actually see some improvements here, especially from the regulatory frameworks across various jurisdictions. Some of them evolve faster, some are less friendly towards blockchain technologies, but we see significant improvements in many major crypto hubs and financial centers like UAE, Singapore, Hong Kong, London, US. So many countries are adapting and introducing crypto-friendly frameworks to allow blockchain technology to improve the financial systems and financial services and make those services more accessible by small investors and general public. So where the confusion really comes from, in crypto markets, non-security tokens often launched directly on public exchanges, decentralized exchanges, centralized exchanges, but RWA tokens are different. They represent regulated financial instruments, not speculative utility tokens or crypto coins. That changes everything about who can trade them and how. Most of the crypto exchanges are not licensed yet for dealings in financial instruments. The big players, as I mentioned, are actively seeking those licenses to enable RWA token exchange, but it will definitely take time to see mass adoption and user-friendly, easy secondary trading. Speculative traders, which are drivers of volume in crypto markets, are not even that excited about RWA tokens, or at least just the individual traders are not that excited about RWA tokens because the token price is not that volatile. In my opinion, RWA tokens are mostly about holding and generating a long-term yield, and not much about spot trading, day trading, quick gain in terms of like speculative gain. The goal of tokenization is not instant liquidity. The goal is liquidity optionality. Let's call it this way. Tokenization creates the infrastructure that can support secondary trading and allow fractionalization and more democratic spread of that financial yield. when regulatory conditions are met, when market demand exists, when compliant venues are available, then liquidity becomes possible, but not guaranteed. Tokenization improves how assets can be transferred, but it's just a foundation. The walls of those tokenized security exchanges, markets, are yet to be improved. And probably one of the most interesting misconceptions is that setting up an offshore entity would mean that you can avoid regulation. While in reality, it does not mean no regulation. In RWA tokenization, setting up in Panama, BVI, Cayman Islands would not really solve the regulatory risk exposure, the need of authorizations and licenses. An offshore jurisdiction may offer tax neutrality, flexible corporate law, faster incorporation, lower structural costs, investor-friendly SPV frameworks, which are good structural advantages, but they do not eliminate securities law, investor protection rules, or cross-border marketing restrictions. The regulators actually look at, they focus on not where the issuer is incorporated. They look at where the investors are located. They look at what rights the token represents, who the investors are, where the investors are located, how the offering is promoted or marketed, where the capital is being pooled, and how that yield is distributed, whether profit expectation exists. If you are selling investment exposure to EU investors, EU rules apply, even if your SPV is offshore. If you are marketing to UK investors, UK financial promotion rules may apply. If you target UAE investors, UAE frameworks apply. Jurisdiction of investors matters more than jurisdiction of incorporation. In early crypto markets, team relied heavily on regulatory arbitrage, but RWA tokenization is different. It involves real estate and other regulated assets, institutional investors, banking relationships, custody providers, cross-border capital flows, and all those participants of this regulated market expect regulatory clarity, regulatory exposure. Offshore structures cannot eliminate regulatory obligations. Offshore SPVs are often used for bankruptcy remoteness, asset ring fencing, tax neutrality, investor familiarity, flexible structuring. They are tools in the architecture, but they must be paired with the compliant distribution strategy. The distribution is the most important stage of that tokenization, right? Because what is the point creating the token if you cannot onboard investors from the countries of your interest, right? If you are interested in dealing with US investors, then you have to comply with US securities offering laws. So the real question is not can we avoid regulation? The right question is which regulatory frameworks are triggered by your investor base and your offering model. Once that is clear, offshore entities can be used strategically, not as a shield, but as one part of your corporate structure that plays certain roles. So as we clarify today, RWA tokenization is not just a technical process, it is a legal, regulatory, financial architecture. exercise. Many of the risks in this space don't arise from blockchain infrastructure, but from misunderstanding how traditional financial rules apply to digital representations of assets. The most successful projects are not the ones that tokenize fastest or raise significant amounts or target vast amount of investors. They are the ones that align structure, regulation, and product design early to avoid any potential legal, regulatory, compliance risks in the future. If there's one takeaway from today, it's this. Tokenization does not change financial reality. It digitalizes it. And clarity at the structuring stage is what turns tokenization into sustainable infrastructure rather than short-term experimentation. And that's really the key to institutional adoption. To be compliant, to be future-proof, and use the available technology for good. Also just wanted to note that each tokenization project is unique. We've dealt with issuers, we've dealt with platforms that are looking to get licenses and act as matching agents between investors and issuers. To really address your issues and answer your particular structuring questions and face and resolve your specific challenges, we welcome you to book a free discovery session with us and see what approaches we can apply to your specific project, to your idea, and hopefully we'll be able to enable your tokenization and make that entire complex regulatory exposure easy for you and help your project remain compliant from phase 0 to mass adoption of your tokens. Here is the QR code to book the session. You can also visit our website. We have plenty of educational materials in our resource center on the website, and you can check more information about our RWA tokenization solutions on the website, or just book a call and we'll discuss your particular project and needs. And now I'm ready to open a Q&A session.
Hi, thank you, Iryna. If you check, we have a question from Yuri Narcissus.
Okay. Sorry, where, Victor? I don't see anything in the chat. Is it in the Q&A section?
Yes, so let me just read it out. It says, Yuri says, what is a marketing language that can be used? Seems difficult not to go into securities territory.
Thanks, Yuri. Great question. Having the marketing language that does not trigger securities exposure is not sufficient if you are really offering a financial instrument to token holders. Marketing, along with the UI, with the front end, are usually two most vulnerable points where regulators can discover that you are conducting an unauthorized offering, let's say. So definitely crypto marketing compliance checklist or guide or marketing compliance session is usually what we include in the package for the clients, for them to understand the requirements and remain compliant over over time, because marketing is not usually like a one-time activity. It's an ongoing communication that involves multiple venues, multiple ways to promote. It could be online marketing, on social media, in Google, or it could be offline, some events, roadshows, etc. So, of course, any language that promises price appreciation, yield, profit participation, or anything of that sort would point to the fact that you are dealing with securities. Again, just avoiding that language in your marketing materials does not completely solve all your regulatory exposure risks. I hope I answered high level. And if you'd like, please feel free to book a one-on-one session with us, and we'll discuss that in more detail to understand what exactly you are trying to offer, and then we can help you design the proper marketing communication and the language. Victor, do we have more questions?
Yeah, that's all the questions for now. Thank you, everyone.
Shall we wait for a couple of minutes for more questions, or let's wrap up?
I think we can wait like a few minutes if there are no questions, and we can wrap up.
I see Ryan is texting us that he already booked a session. Great, Ryan. Really exciting. Hope to see you, I think tomorrow is our session, and we'll address all your questions there, if any, and we'll analyze your project in more detail. So this is the first webinar in a series of webinars dedicated to RWA tokenization. Please follow us in LinkedIn, on our other social media channels. Victor, maybe we can also inform all today's registrants about the upcoming webinars when those are launched. We will have a dedicated webinar discussing in more detail each type of financial instrument that can be linked to that RWA token. As we mentioned today, it could be equity rights, it could be some contractual claims to the cash flows of the issuer. It could be fund units, some debt instruments. So we'll cover all that in the upcoming webinar. Also, we'll have a more detailed webinar about smart contract design and compliance features related to RWA tokens. That will be a joint webinar by Legal Notes and one of our partners involved in the technical layer of tokenization. And we are planning a dedicated webinar that will be about each specific jurisdiction among those most popular geographies for RWA tokenization: Luxembourg, UAE, US, and hopefully that will give more clarity to all RWA projects in terms of where to host their SPVs, issuing SPVs, and how to approach this complex process, where to start, and how to compliantly launch that RWA token. Okay. Thanks everyone for joining. I hope this session was helpful, and then see you on the next webinars in our RWA tokenization series.
Thank you. Bye.
Thanks everyone. Bye.